Noble Capital. Today, I have the pleasure of introducing NN Inc. Following the presentation, we will have some time for Q&A. NN is a precision component manufacturer with extensive experience in machining, stamping, and precious metal plating. With us today from the company is Harold Bevis, President and CEO, Tim French, COO, and Chris Bonert, CFO. The floor is yours, gentlemen.
Thank you, Joe. Appreciate it. Thank you for everyone that's listening in. We have a brief presentation for you. Go to the next page. We have some forward-looking statements. Please read those quickly. Okay, that's fine. Investment thesis. Let's just start with that. We are a transformation company, and we're entering phase two. We have new leadership at this company. We came in about 2 years ago, and the first order of business was to correct some of the problems we inherited, stop the bleeding, if you will, and initiate a business development program and some restructuring. And we've accomplished the majority of that. And we are entering our second phase of this transformation. Our core markets are bouncing off the bottom. The outlook for our markets in 26 is improving versus 25. So in this update, you'll hear a few more positive things about the market than have preceded us in the 2025. On new business, that program's been working well for us. We've pivoted in a couple areas. We've added a couple areas, deleted a couple areas, but overall, we're right on track to secure $200 million of business by the end of this year. And we're now launching programs that we've won, and we have a decent amount. Tim's going to cover them later. And Chris is going to refer to the balance sheet things that we're doing to correct an overhang that we have with some preferred stock that we inherited. And we're well underway with different ideas there also. So our transformation is working, and we're entering phase two. At a glance, for those of you who may not recall who we are a metal part maker. We make custom metal parts. We direct sell them, usually with sales engineers. We've been doing this for about half a century, and we've been public for 3 decades. We go to market under other names. NN is really a corporate moniker, and we have several markets that we serve, which is a good thing. We're balanced across multiple markets, and we do not have customer concentration either. At a glance on the financials, we're $434 million. We also have an additional $130 million JV that's not consolidated into our financials. Our EBITDA margin is about 11%, $47 million. We lead 3,300 people, and we have about 600 customers. Secret sauce, there's people.
$80 million. You do not want to store them outside or in a community hangar where they could be, enter into some type of rash accident or so on. So overall, we see the cost of storage as being relatively minor compared to the flight department, the pilots, the fuel, the financing of having one of these planes. And that is what makes it our tenant base very inelastic, because once you're in business aviation, I think in a downturn, a lot of these very wealthy, ultra wealth individuals, billionaires, some cases trillionaires, and corporate fleets, the last thing to go will be the plane, and so on. It's difficult to go back to commercial aviation once you have your own flight department.
Excellent. Well, Francisco, really appreciate the time and the presentation. Thanks to you and Tal, and thanks everyone for joining us today.
Thank you, Pat, and thank you, everybody, and look forward to in-person meetings. I think it's in Florida, correct, Pat?
Correct, yep. Early December.
Early December. Thank you.
Yep, thank you. Bye.
Years, we inherited that good business. We also have footprint in South America to serve the South American market, 2 plants in Europe, and multiple plants in the United States. Just want to touch a minute upon our served markets. 40% of our revenue is tied to automotive vehicles, passenger vehicles. some of the markets have been going through some turmoil, especially Europe and the United States, with tariffs that have happened this year. China continues to power through. We're the beneficiary of the resurgence of that market. The China passenger vehicle market's about 29 million vehicles versus in the US about 16. So it's the largest car market in the world. Electrical grid and electrical distribution has been humming along in the United States due to data center advancements. A new area for us that we've cut out so that we can have investor visibility is defense and electronic systems, which have done well for us in the United States and are growing. GDP-linked businesses are steady with GDP, and commercial vehicles are another market we serve in Asia and in the US. The Asian market is up and the US market is down, and medical equipment is a market that we re-entered about a year and a half ago and has become now a part of our revenue. So overall, market's a little bit soft overall if you weight some of these comments with an improving outlook. We have a strategic plan that we are organized around. On the sales side, we are attempting to get 5 to 6% CAGR by winning new business and having an orderly exit of programs at their end of life. That program has been working. We also have a cost program that Tim leads to offset our inflation and price downs, as well as deliver net productivity to the company. The goal is to drive up our EBITDA margins, and we've been doing that. And then, of course, generate free cash flow to fund CapEx, fund our capital structure, and pay down our leverage. Next, we wanted to cover a couple of our financial statistics.
Thanks, Harold. Through the second quarter of this year, you can see improved adjusted gross margins and adjusted EBITDA. So the chart here shows from 2023 through 6 months of 2025, as well as our longer-term goals. So significant improvement as a result of the strategic plans and things we've put in place over the past 8 quarters. Margins, adjusted gross margins increased from 16.3% to, as you can see, to 18.2%, well on their way to the 20% goal that we've got. Additionally, the adjusted EBITDA margins improved as well. In 2023, they were 8.8%, growing to 11.1% on a path to around 14% as a longer-term goal. Again, these improvements have been due to shedding unprofitable pieces of business, closing a plant, our improved continuous improvement culture and one team culture, and implementing lean culture across the business. Tim?
As we discussed, our new business win program is very strong and robust. Since 2023, we've achieved $182 million of new business through August of this year. Well on track to hit our goal of $200 million. Our pipeline remains very robust at $750 million and being run by a team of 40 people. Our hit rate is approximately 24% on closed opportunities. If you look at the launches of these new businesses, we're launching approximately 110 new programs in 2025. We're expecting to see about $26 million of revenue from those programs with a $48 million annual run rate. Most of these opportunities take 12 to 18 months for us from the time we've become aware of the opportunity till the time it's awarded. And then there's another 12 to 18 months before we get to peak annual sales. As I mentioned, we have 3 operations in China. We have 49% of ownership of a JV in Wuxi. We have a stamping facility in Foshan and a machining facility in Wuxi that are all wholly owned foreign entities. You can see we've had really strong growth in China and are anticipating to see that continue. Our operational leadership program is driving the cost reductions that Chris mentioned earlier. We're offsetting the price downs and also adding 1% productivity. We're on track to achieve our $15 million of cost out in 2025, and that's through the continued management of approximately 345 continuous improvement projects. We've also had significant headcount reductions, and we are also focusing on our approximately $200 million procurement spend. Our quality is Six Sigma or better delivered. We're ahead of the goal. We have green scorecards with all major customers, which opens up opportunity for new business wins with our existing customer base. Our target for on time and delivery is greater than 98%. And as I said, green scorecards with everybody. And our working capital improvement is an ongoing program. Year to date, we're about 20% of sales, and our target is to get to 17%. Tariffs are having a bit of an impact on that, but we're still working the balances down as we go forward.
Wanted to touch on the M&A strategy here. We've been public about it. One of the big value-adding aspects of our longer-term goals is to add to our portfolio. We've been asked about what specifically are we looking at. One is we're definitely looking for the right cultural fit to our company because our company works. We've corrected our team where needed and leaned on our team where it's strong already. So we want to add to the culture. Clear cost and commercial synergies are areas that are important to us. We want to deleverage the company. Ideally, we'd like to be in the twos in terms of secure leverage before we acquire. We're looking for strong existing teams. We're running a lean team concept, so we need people that thrive and desire that type of support structure. And then fundamentally, where the sum of the parts is stronger than the individual company. So we've been very active. Tim and I were at an acquisition candidate yesterday. We're going to another one in Wisconsin next week. This is an area that we're experienced with. Tim's bought 25 companies. I've bought 15. We are being selective so that we build a company that naturally fits together and is stronger and leads to free cash flow and deleveraging. So it's a very important part of our go-forward game plan. Lastly, just wanted to repeat the investment thesis. We have new leadership. We've been here 2 years. I guess we're old now. You know, we're the new old guys, but we've been happy with our progress so far, and the team that we have has responded well to new leadership approach. And on an LTM basis, we've been able to increase our EBITDA almost 50%. And there's more to go, as Tim and Chris both touched on. Our markets have been tough with the new presidential administration and the tariffs and the uncertainty. But already Wall Street's pricing in an anniversary of those new things that have happened, and 26 being modestly better. Our new business program is starting to be launched in terms of incremental sales. We have over $100 million of wins that are not in our run rate that we have secured and that are ours, and that we're underway with putting into place. And then the balance sheet, Chris is leading a pretty complicated program to re-engineer and redesign our cap stack. And it's an important thing that we're working on. And we get a lot of questions about that. Some of them are, material, non-public information kind of thing. And if you're wanting to invest or participate, you need to get with Chris and sign an NDA, and then, he can tell you what's going on. Other than that, we have a duty to keep it private. So overall, we're really satisfied with where we're headed as a company. Turn it over to you, Joe, and we can do some Q&A.
Thanks, Harold and the team. Great, insightful presentation. So let's start with tariffs and how are things like tariffs, the elimination of EV rebates impacting NN's businesses, and what steps has the company taken to overcome these issues?
Yep. Tariffs are a big deal for the industries that we serve, but they're not that big of a deal to us specifically. They impact our customers. And because we have a program that we inherited, thankfully, where we source materials locally for the local market and convert them, we're a tariff problem solver. So generally, we've been seeing RFQs come to us with people that are wanting to switch their supply chain from sourcing from China to sourcing from USMCA, and that specifically happens. Tim and I were in Detroit last week with a very large tier one customer, one of the largest in the world, and that's exactly what they're doing. They were trying to have us help them move parts that are currently made and sourced in China to USMCA. So tariffs are driving changes in supply chains in terms of the tariffs themselves and surcharges. When we are the tariff payer, we pass them through. So we're not getting a margin compression from it. And generally speaking, as I've mentioned, it's a small topic for us. So Joe, it's primarily causing new business opportunities to open up for us is kind of the net bottom line of that.
Great. Now, you talked about the new business wins. There's some good momentum there. The pipeline, it still stays in that 750 million region. How do you see this positively shifting the sales mix and the margin profile, and how does that relate to your 2028 net sales and EBITDA margin goals?
Yeah, so as Tim mentioned, we're running about a 24% hit rate on closed opportunities, which actually is a little higher than we expected. We're happy about it. It is a game of numbers. We manage the pipeline with Salesforce.com, and we've done this before. And you have to have enough activity in the pipeline so that you can cherry pick it for the best projects in terms of margin and return. Tim monitors also our capital efficiency. What are we running, Tim, for CapEx to new sales?
29 cents, approximately 29 cents for every dollar of peak annual sales.
So we also balance our CapEx across the categories. And overall, the knock on wood, the program has been delivering what we want. Joe, we've done a couple pivots here and there. Like, for instance, the defense market in the U.S. has really surged with President Trump. And we were in a position to benefit from that, and we are doing so. So we saw the market open up, and we went straight in. And we put out a press release this week that we have won a big position with a weapons manufacturer, and we're participating in that. So overall, we think that the pipeline's about the size that it should be.
Great. So let's stick with the defense win. I actually have a question here from the audience. How big is the new defense win, and how do you see this new initiative ramping?
So we are getting our certifications in order. We have certain certifications that allow us to participate as a manufacturer. Tim sat through a Department of Defense presentation last week on the additional certifications we need to participate more fully, in this case with the Navy on their next generation program. So we have a heritage of making certain parts, and it was why we were approached to make other parts. And Joe, it happened, and as it turned out, we didn't even have a salesperson that could speak the language with the defense. And so we're actually looking for a leader now. These have been POs and inquiries that have come into us unsolicited, and they've been, and it's consistent now. So we've noticed a pattern, and we're reacting to it. So we're getting organized, but at the same time, it's a little bit different than the automotive business. It's POs. So it's not the 1 year lead time. It's like, can you make this now? So it's a now market, and it's helping us now.
Great. Let's switch gears to the medical market. I know that is a business that you've been very excited about getting back into that. Maybe you could just give us a little update on how that your efforts in the medical field is progressing.
Yep. If I had to contrast it to defense, we're getting pulled into defense, whereas in medical, we're trying to push our way into a fully served market. It's been harder than we thought, Joe, but we've been consistent. We now have over 60 machines dedicated to medical part manufacturing. We're continuously expanding the plants that are certified to make medical parts. We're growing our medical pipeline. We've added a medical payroll, a dedicated team. So we've invested SG&A as well as CapEx to be a player here, and we have a pipeline, and we intend to grow. I would say it's gone slower than expected, but it hasn't caused us to change our minds about attacking it. We're consistently going after the medical market.
Okay. And one of the things that, you guys have done here over the past, 18 months or so is, asset optimization of the footprint, especially. Do you anticipate more asset closures, fixed variable cost rationalization? How much more room for improvement is there in the cost structure?
Yep. You want to take that, Tim?
Sure. As you know, we've closed 2 facilities. We have discussed or mentioned it in some other areas where there are likely to be 1 or 2 more in that area. We still think there's room to go. We've really only just getting started. We focused on the group of 7. For those of you that have been following us, of problem facilities, we closed 2 of those. 4 of the 5 remainders are now break even or better, and we have 1 left that we're focusing on. But no, we still think there's runway for additional operational improvement to help continue to drive the gross margins up.
Okay. I'm gonna put one out there for Chris, because it's also come up on the web here. What is your thinking on how to best address the preferred equity? What creative options are at your disposal? Any additional steps you'd like to take on the capital structure?
Yeah, great question. Thanks, Joe. I'm not sure how creative I am being an accountant, but we're definitely putting a lot of ideation to it. It's the next step in improving our capital stack. As you know, we completed the ABL back in December of last year, term loan in April of this year. So it's top of mind right now. I think we're going to use, any tools at our disposal. We're talking to a lot of folks, getting a lot of input, and trying to, overall, the goal is to reduce the cost of capital for the business. So that might include equity. It might include a little bit of debt. But we want to make sure that whatever we do eliminates the overhang and creates a sustainable business going forward from a capital standpoint, so we can continue to do some of this M&A work and buy and keep delevering as we go. So it's top of mind.
Okay. And let's finish up. We'll go back to the M&A for a second here. You talked briefly about it in the presentation. There's a question, could that occur by end of the year M&A? Are you looking at small bolt-ons, something more transformative? Harold, maybe you could just talk a little bit more about the M&A opportunity.
Yes, sure. We have an active program. There's multiple targets in it. Some of the targets we proactively called them. Some of the targets are processes that are underway that fit our criteria. We are working hard on it. We'd like to try to get something done end of this year, beginning of next year. It depends on the due diligence processes and all that. We can't control the timing. It's obviously two parties, but it's an active activity. And we believe it will allow us to make an advancement on our cap stack, specifically the preferred. The size of opportunities we're going after versus the size of the preferred, it's likely that it's going to take us a few transactions to have a full conversion. And so that's what we're expecting. And so we're viewing this as it's likely to be a few refinancings. And so we're getting set up to do that. Right now, we don't have an advisor. Chris is managing it, and he's seeking advisors for various parts of what he's doing. And we're excited about it. It's going to be an improvement for the common stockholders of the company.
Great, thanks for that. Well, we've come to the end of our allotted time. We covered a lot of ground today and got significant insight into what NN does, its markets and opportunities. We appreciate you taking the time to participate in our conference, and we wish you and the company the best in the future. Thanks again, guys.
The gift of all time. So I would love it.
Of course, wouldn't it be
But
amazing?
how are they going to replace that kind of revenue, the state? I don't get it.
I don't know. That's what I was thinking. And
I have no
quite
idea.
frankly, there's